good morning, good afternoon, or good evening, depends on where you are in the world. My name is Helene Lee. I'm the co-founder of Go Impact. I'm also the general manager of the Hong Kong FinTech Association. I'm delighted to moderate this panel and to welcome really a diverse group of panelists who are all experts in their own right from around the world into this very timely discussion on how wealth tech actually can be a driver for responsible investing. So on that note, before we go right into the crux of the matter, let me welcome the panelists and let them say hello to you first. We've got Ned Phillips from Bamboo. Hello, Ned. Nice to see you here.
Hi, Helen. Nice to see you. How are you?
Great. And we've got Srinivas Jan. Hello, Srini. How are you?
Hi, Helen. Good to see you too.
Absolutely. And we've got Amir Taub. Hello, Amir. Very delighted to have you with us.
Hi, Helen. Thank you. I'm very excited to be here.
Thank you. So maybe with Ned and Srini and Amir, I'd like to do just a quick 30 seconds intro about who you are so people know before we get into the discussion flow. Ned?
Sure, why don't I start? Thank you so much. So I run a B2B wealth tech firm. So we design and build these robo-advisory or automated wealth solutions. I am an older founder, so I am 54, but trying to relive my life in the startup world. And my business has been going for 5 years. We build these wealth tech solutions globally, and we're purely B2B. So we design them for some of the world's largest financial institutions, from HSBC, Standard Chartered, Franklin Templeton, and we're based out of Singapore. And I'll today really commenting on how technology is enabling more people to save and invest, and as more people care about responsible investing, I think the two go hand in hand. So that'll be the kind of perspective I'll bring today.
Hey, thank you so much, Ned. You have in me another seasoned co-founder. I left the banking industry to found Go Impact. I will not disclose my age. However, definitely I'm not a college dropout with the biggest idea and say, hey, give me $50,000. I'll, bring you a POC. Anyway, so investor education on sustainable finance is definitely something we are very passionate about. And I love to explore with everyone here and hear all the expert views as well. After all, living and learning every day is what it's all about. Sorry, that's a long-winded way to introduce Srini. Over to you, Srini.
Thank you, Helen. A quick one. I work with SBI Funds Management as Executive Director. I handle strategy and sustainability for the organization. We are one of the largest managers in Asia. We manage about $175 billion of assets. We have been very early adopters of ESG in our investment process are now close to a decade, and also have been recognized very well for our capabilities of handling ESG globally. Locally in India, of course, we are the largest investment manager for ESG assets also. And I keenly look forward for this interaction with all of you.
Thank you so much. Over to you, Amir.
Thank you, Helen. Well, I landed in the wealth management and wealth tech world by luck, and happily so. After graduating from business school, I went to work as an intern in the retail division of a bank back home. And it wasn't long before I had to deliver something to the private bank, and my eye caught a glimpse of the Reuters terminal at the time. I was immediately captivated by that world, and it began making connections with the private bank. And when the opportunity arose to be a trader representing the bank of the floor of the stock exchange, I took it. And financial markets and wealth tech have been my passion ever since. I'm currently the head of multi-asset class trading and brokerage at Emirates Investment Bank. Before that, I ran trading and investment advisory at National Bank of Abu Dhabi. And my involvement in fintech transpires particularly through my work on running a wealth management platform and an algorithmic dealing desk, but also through my association with advisory board of various fintechs specializing in wealth tech and RegTech for capital markets, brokerages, and asset management.
Hey, thank you so much, Amir. I think everyone can tell the diversity of background, but with a common kind of focus. Everybody brings different perspectives into how we see this momentum of ESG or responsible investments have taken off. And I was doing just a little bit of quick reading, in the past couple of days. MSCI's investor survey of 2020 actually listed about 73% of the population interviewed as wanting to make major increase in their ESG investments in the next 2 years. Okay, so that's a very significant number, and those are largely institutional investors. If you look at the ESG inflows last year, it's more than just a knee-jerk reaction from COVID that people look at sustainability. I think it really is, a tsunami across different asset classes. So the first question is to all the panelists: how do you see this tsunami of responsible investment and ESG shaping out from where you are in your different perspectives? Maybe we start with Srini.
Yeah, sure. So I see this at kind of a 3-level benefits that are there. Firstly, there is an increased in investor interest and understanding of ESG. This is what we already talked about. There's also greater appreciation of ESG issue that's being material, right? The core business issues that have been like themes or esoteric investment styles that are there. Second is that this has translated into actually ESG-led investments, right? This is something that the fund managers have been able to package over a period of last few years. It's not just the demand is led with the products that have come out of the market. The third factor is, I think, there is an increased availability of high quality data. Some years ago, even though we wanted to do it, this data was missing. Today, high quality data of corporates and investment universe is available. This has kind of made this happen. We see significant interest in investors coming. In fact, as of last year, the global investments in ESG itself had gone up from something like 3.2% to 4.9%. So it's no more a very small portion of investment. It's a significant portion of the asset size that's going on. We see very similar trends happening here in India. I think this has now led to tsunami, as you said, of new product ideas and new offerings that's available to investors. So we see this just the tip of the iceberg. And I think the whole concept of sustainable investing is going to explode further, especially in emerging markets like India, China, and other markets, which is still very, very new to this concept.
Yeah, I think that's a very important point to note in emerging markets and the trend and how that shapes out. I just like to mix up the panelists a little bit so that there's no particular thing. But on this, because Srini actually mentioned data, so I'd like to turn to Ned really quickly. How do you actually see that shaping out? Is that a very important driver from where you are, from what you have observed?
Yeah, look, we all talk about data a lot, and it comes in different ways and forms it can affect. But if we just think about ESG investing, I use this word a lot generally in WealthTech, but we can definitely use it for responsible investing, is accessibility. So previously, let's say 5-10 years ago, less data, less tech, less accessibility, right? People didn't know so much about how firms were being responsible in how they conducted their business. So they had less information, less data about which firms to invest in. Similarly, with the technology now, people can start investing in a global portfolio for as little as $10, right? So now we've got, and particularly with technology moving to, I'm going to say the younger generation, not trying to be ageist again, but the younger generation, people who have, let's say somebody's 25, they have $10, they care about the world, possibly more than my generation did, not saying we didn't, but they can actively go and make a difference, even just $10 at a time. I mean, the famous saying is, what does it take to change the world? It's one small step that starts it. And I think when you talk about the tsunami of change, it is both data and accessibility. We all know now that we could start investing in global portfolios, and now there's so many different types, not just environmental, but diversity and, animal welfare and different areas. But before, it wasn't accessible because you had to have $100,000 to invest, and you couldn't do it through an app. And you also didn't have the same level of data. And it works both ways. People who show a care for responsible, not just investing, but in terms of how they conduct their lives, the investment firms can get their data and say, oh, okay, whether it's everything from the World Wildlife Foundation or, caring for the oceans or whatever that might be, the data works both ways. So I absolutely feel that the real tsunami coming is that the voices that previously couldn't be heard can be heard today. And those voices, Helene, use the number 72%. I mean, and look, we're talking about the world where people, let's say in the US, not everybody, most people have got some dollars to invest. How many people would say that they don't care about the planet? It's very few. And the reality is, with a combination of data and tech and the way that the world's going, I think the tsunami and the amount of interest is only increasing.
Absolutely, Ned. I'm really curious to hear from Amir about, how you see it, from MENA, from the Middle East and Africa region, and if there are any, other perspectives you might want to add on. Thank you, Amir.
Thank you. Well, over the last decade, Helen, the number of assets under management that include some element of ESG investing has increased rapidly. And we can clearly observe that investors are increasingly applying these non-financial factors as part of their analysis to identify risk and growth opportunities. For instance, the sustainability bond market continues to grow exponentially. The global green bond supply is predicted to jump 50% in 2021, and it may still not be enough to satisfy investor demand. After a record year for sustainability-related debt issuance, demand for sustainable and green bonds is set to go through the roof this year. So according to S&P Global Ratings, global sustainable debt issuance is expected to surpass $700 billion in 2021, up from $500 million from 2020. Morningstar statistics also reveal, and this is something that we follow in our realm, in our turf, the number of launches of funds using ESG guidelines jumped from 140 in 2012 to 564 last year, including open-ended funds and exchange-traded funds. So for us, as long-term capital managers and the organizations that I've worked with, they see ESG, sustainable investments, impact investing as a mandate to examine whether the firms they currently hold will be able to retain a strong relationship with their customers and broader communities, but also understand that these organizations commit to confronting these concerns head on, for example. So in our realm, we call it the power of purpose. And it's a cause we encourage, and we somewhat see the private sector enterprises, investment managers or asset managers gradually embracing. And this is one of the ways we see that it can play a considerably active part in the pursuit of environmental sustainability and other social goods. So simply liquidating shares and exiting positions in the face of problematic corporate governance is no longer a solution, at least in our view, for businesses and investors.
Absolutely. You mentioned purpose, Amir, which is so important. I think that's the underlying thing that we see increasingly, weaving into people's business models, into the way in which people make their investment decisions and all that. And there's one mantra that I always keep talking about in any advocacy work that I'm involved with is purpose really shapes the next profit. It's not just profit for the sake of profit at all costs, but profit with a purposeful way. How do you actually go about that? Now, there are two things, it seems, that really drive this agenda, if I hear the gentleman correctly. One is, of course, capital, okay? The other one is tech. So in terms of capital, if you look at the capital owners, and Ned was referring to that, are the younger generations, the millennials and the Gen Z, of the ultra high net worth families or your clients or others, are these the target market to drive responsible investing or ESG investments? Or do you actually see a broader audience than that? I mean, it has been a bit of a cliche to say that, oh, the millennials and women care about ESG much more than the other generations. I don't happen to really fully agree with that, but I'd just love to hear everybody's perspective. Maybe Srini?
Yeah, I think, Helen, I think it's the next generation is a lot more attuned to ESG investing. They're a lot more naturally inclined to conscious of environmental and social issues, right? So the young generation, because they have this conscious level of the carbon footprint, the impact of human activities on the environment, things like social equality, racial inequalities, these things are top of their mind. May not be in our generation, but in their mind, it's top of their mind. They see that on their social media every day. They see it on their own set of stuff that they're doing. So this is actually, this reflects through very different consumption choices that they're making, right? It's also basically results in something we've been looking at from a trend point of view, it's very difficult to sell them something which is very attractive, but not socially conscious. So everybody wants to see extra value beyond what they're getting. So today, for investment managers like us, storytelling has to be completely different for that generation compared to the generation that used to sell before. So I definitely see this expansion in ESG interests coming from there. But as I said, the data kind of tells you that it's not necessarily only millennials who are interested in it. They have influenced a generation of retail, non-millennial investors, and also significant amount of funds coming from the institutional investors. In fact, the institutional investor is one of the biggest investor base, especially the sovereign wealth funds and others. They are a very large investor base for ESG investing in the world. So I would say the primary market definitely is young millennials who have very close interest in social responsibility, in environmental impacts, but it's also now rubbing off on all the segments.
Yes, I would agree with that. I think the millennials is a driving force. They vote every day with their purchasing power, with their investment power, whether it be like, $10, $1,000. Look at the story of GameStop. Yeah. you can tell. But it's also more than that, right? I mean, the sovereign wealth funds, the larger AUMs are really going into this and continuing to really demand more offering in that. Yeah. Ned, would that Absolutely. Be the perspective that you're seeing?
Yeah, to a degree. Yeah, to a degree. But I was actually, so I host my own podcast, and I had a gentleman on. He's 31, 32, so still a millennial, an amazing guy. And he said something that was super interesting. He said, look, Ned, I've been an adult for 12 years, 13 years, he said. And I've been let down twice by the world, once by the GFC and again by COVID, right? Now, when I left school, I was told you put your money, you invest it, and the markets generally are directional, and the black swan event doesn't really happen. But think about it. For people in the last 15 years, they've had two black swans. Black swans are meant to come, as Nicholas Taleb said, rarely, not often. So I think there's two things at play here. Investing isn't just such an obvious game. I mean, take away the GameStop and this little crazy market scenario we're in, but there has been these rare events. So look, I did economics at university. It was very clear. You invest capital to make the best returns possible. There wasn't an ESG class when I was at school, right? If I'd been told, what is the percentage you're willing to give up in return to care? I don't know if anybody could say the actual percentage, but the way this gentleman I was speaking to on my podcast, he said, Ned, you can't prove to me that the system works anyway. So I care more. And I know my voice is important. And I think they're saying that voice within ESG. So I think people would be willing to give up. Is it 1 basis point, 100 basis points? This is a question I would be fascinated to hear. If you said to somebody, how many percent are you willing to give up a year? Is it 1? Is it 3? Is it 5? Is it 10? Right? And then that would test where it is. And I know that's not the defining point. But if we get into the mindset of people, we all know the world needs more love. The world needs us to take care of it better. And I think we're all willing to give up a bit. For me, the sliding scale is the younger generation are willing to give up more because, hey, look, the system's let them down twice already. So we might as well care because the world's got a long way to go. You couldn't tell a millennial or a Gen Z, the world will be fine for the next 50 years. It hasn't really. So I really do think that it's not just the millennials or Gen Z of the ultra rich. It's anybody who's lucky enough to have money to save and invest. Which, let's face it, it's a smaller percentage of the population. A lot of people in the developing world don't have money to save and invest. We're talking about the more privileged part of the world. I think that it's soon, the percentage that you will give up in returns to, and I don't want to be controversial, but to care or show you care is just increasing all the time, even if you've just got $1 to invest.
Can I just maybe?
Yes, please.
I'm just trying to get this very interesting point that Ned made of giving up on maybe a return, right? Or that you expect from I think anecdotally, we've now proved with almost a decade of investing in ESG related that you don't have to give up on return. good corporate governance company, good environmentally conscious company, companies which deal with equality in a longer period of time have always done better, right?
That's
so
right.
You don't have to compromise on your return just because you're using an ESG filter or sustainability filter on top of it. So I don't even know whether that concept of giving up on return, which was there maybe some years ago, where they said, okay, if you run an ESG fund, maybe it's not as best as running a tech fund or a high risk a fund, but that may not be true. I'm sorry to butt in, but it's an interesting point that you brought in. But we see more and more that that's not true anymore.
And that would be what a wonderful outcome. We've always been told you can't have your cake and eat it. Well, if you could invest in responsible investing and get outsized returns, then why wouldn't everybody do that?
Perfect. Yeah, I think that's a very interesting point, and I'd love to get Amir's point in it. I'm a little bit more on the side of Srini in the sense that I feel every investment is a trade-off, okay? I mean, in one form or another. So you can't go into ESG, expect there are no trade-offs. I think that would be, not realistic. But it's, we've seen actually that ESG lens can still perform, deliver exceptional return, and in some cases, in the midterm, even outperform some of the others. So Amir, you've been doing this for some time. What are your perspectives on this? We would love to hear that.
Of course. I agree with Srini, and I would like to tell Ned, as a millennial on the panel, when it comes to the next generation investment, yes, they do have more time to care and more time to invest. And the world's wealthiest people are expected to pass $15 trillion in private fortune to their heirs, to the new generation of high net worth individuals by 2030.
Wow.
These younger members are taking a new approach and are more receptive in general to the idea of responsible investing. So if we look at 2019 survey released by Alliance, 64% of millennials are inclined to make investment choices based on social issues relevant to them. And this includes investments in environmental and social products. But in order for the wealth transfer and the change to new investing paradigms to be efficient, they must continue to focus on creating trust across the generations. So it's not solely about what the next generation wants. Money in its distribution generally in families is associated with emotion, and friction will inevitably arise among family members of various generations. But nonetheless, both the older and younger generations seek guidance in closing this gap. And during this time, it is extremely vital that families that are considering more sustainable investing to properly educate themselves, like Ned advised, identify how they want to invest, where they want to invest, and determine the correct investment solutions. Now, Srini mentioned a lot about the institutional investors, and we spoke about the younger generation investor, but there's also the private investors and family offices. And it's clear from the data that there's an increase in demand from the family offices. According to UBS, the 2020 Global Family Office Report, which studied 121 of the world's top single-family offices worth an average of $1.6 billion each, 2/3 of families believe that sustainable investment is crucial for their legacy. And 39% of the family offices surveys anticipate that their portfolios will become sustainable in 5 years, owing mostly to exclusivity or exclusive policies that allow family offices to reject investments that do not match their values, in addition to selecting ESG and impact investing projects.
That's really perfect. We are reading the same report, Amir, and thank you for quoting that, so I don't need to repeat that. I think the private investors in the form of family offices, not only a generational transfer, but the influence that the younger generation would have as they are poised to take over some or part of the family's wealth, it really cannot be ignored, in addition to the more institutional investors that Srini was referring to, like the sovereign wealth funds and those. Now, which brings to point another very interesting point. Apart from capital, which we feel is ready, tech, what are some of the tech solutions that you have observed is driving that? Is it the robo-advisor? Is it, democratizing the access to investments? Or is it other forms of wealth tech that you see, being crucial to take this forward? Who wants to take that first?
I'll start before Ned says anything, because he's going to take on the entire conversation when it comes to wealth tech. And and someone has to defend the millennials. It might as well be me. So like you mentioned, 73% of the organizations who have issued sustainable financial instrument reports, they said that they have increased their capacity to implement these accountability standards. And the WealthTech Forum, the WealthTech firms recognize their capabilities and what they can bring to the table. And they have begun to offer, at least in our industry, highly adjustable and scalable solutions that ensure that each client-specific company demands and growth objectives are met. Some of these, for example, WealthTech firms are providing advisors, wealth managers like ourselves, and even private investors with institutional investment skills through individually tailored SMA portfolios that mix the different smart beta type of variables and strategies with the ESG features. We've seen web-based portfolio creation tools that enable advisors to build risk optimization, ESG factor, and impact investing strategies in minutes now. And the employment of data, which was mentioned, to support investors in making the right decisions through the assimilation of transparency and ESG responsible investing. And of course, the rise of robo-advisory, which our fellow panelist is a superior expert on that. The robo-advisors platforms now include ESG and impact investing as part of the portfolios. And I think Ned can share a lot more details and perspective on that.
Well, over to you, Ned.
Yeah, Amir, appreciate it. Yes, I run a wealth tech firm, but I'm certainly not a tech guru or genius. Definitely, I've always, for the past 30 years, I've sold tech. I don't build it, I don't design it. But I remember when we first put broking online in the 90s, I remember they said, what do you mean? Nobody's going to call their broker? How are we going to trade online? This was before the web was obvious. And today we can look back and laugh at that a little bit because it seems strange. A bit in the same way that I think we all regard scheduled TV as kind of quaint and weird these days, whereas even 10 years ago. And I think ESG and responsible investing is going the same way. And this is what tech has happened. Even if we just take away the word robo-advisor, and I know I keep coming back to this point of $10, but if I had $10 10 years ago, I have zero ability to make an impact to any company and vote with my just $10, right? I don't know how to buy stocks online. I can't meet a financial advisor. I don't have the data to understand which company is doing the right thing. Now, when we look today, there's so many companies that can pre-build portfolios. And again, the word robo-advisor kind of says that it's an algorithmic kind of secret black box. Let's take that away. Companies that have zero or net zero carbon emission, companies that are positive to the ocean, animal welfare, whatever it might be. These are incredibly accessible, even as accessible as turning on Netflix and watching, right? And you can transfer money really quickly and really repeatedly. And here's the other main thing that I really think that wealth tech has done is you can share. Just like in social media world, I get three things when I invest in an ESG portfolio, which technology has enabled me to do that I couldn't do before. Number one, I can do it at any amount at any time with minimal friction, and it doesn't matter how much money I have. Number two, as Srini says, hopefully I get a good return, so I can invest. So I show I care, I invest, but equally important, I can tell people that I care and I invest, and I can tell other people it's the right thing to do. And as Srini says, and if we get, and we seem to are getting to the place where, hold on, I'm investing in responsible companies, I'm getting a better return, I'm doing the right thing, and I do it easily and frictionless on an application on my phone. This is the easiest doing anything else. It's revolutionary. I mean, it's true. I think we all live in the fintech world, and we take it a little bit for granted. But that just think about it. 10 years ago, I want to make an impact with my small amount of money, and I want to tell people I've done it. And that's why it's spreading like, I don't want to use the word wildfire, because wildfire is a bad ESG terminology, because that shows that we have a global warming. But it's the simplicity of tech, the beauty of tech. It's, that, and this is what, we design and build these robo-advisory solutions. We have over 300,000 end users. And the critical part is that ease of use, emotional. And I think, Amir, you mentioned the emotional side of it, right? I feel good that I'm able to invest. And technology allows people, and these wealth techs, I have this little phrase, if the world of wealth tech is going to be a whole year, and I think we're still in January. I think we're maybe in the first 2 weeks of the year. I think in 10 years' time, we'll look back and kind of laugh at how quaint we thought, people in 2021 thought that ESG investing was something that was new or hard to do. And like anything, it moves on. So yeah, I'm super passionate that we'll see the biggest revolution and the biggest ability to vote with your money ever. And it will be amazing for the world.
Absolutely. Srini, at what month do you think we're in?
Yeah, I would tend to agree with that. It's very, very early days. We do something completely different from what Ned is doing, right? Which is about building everything at the front end when it comes to investor accessing high quality capability when it comes to ESG and making that difference. And that's a very, very important thing the wealth tech brings to the table. We do a lot of tech on the back end. And what's really important is when the money is given to us, how effectively can I do that by using technology, right? So there is huge amount of responsibility for us to do high quality attribution around how do we manage this responsibly, the way we perceived, the way we've told we're going to manage. Historically, it used to be an MSCI index, and I just want to take that data out of that and try and invest in that universe and beat it. Today, it's gone far more complicated. We just don't do investing just because I'm trying to generate alpha. We do a whole lot of engagements with the investing companies. We do advocacy, we go meet them, we give them tons of data. We have our own technology solutions, right, which we've built internally to look at some of these big movement that happens in impact that happens in the investing companies that we've invested in. We also take data from outsource. So we've built all these tools and solutions to make whatever we are already doing much more better. One other thing we did, Helen, some years ago is that everything was a product portfolio level, right? We launched an ESG strategy, and it was an ESG strategy specific approach for a very long period of time. That particular portfolio had an ESG overlay, and today in the last couple of years, we've moved it at an asset management level, right? So today, in the next few years, it is going to be firm-wide, organization-wide. So there is not going to be an ESG specific strategy. Of course, there'll be an ESG specific strategy, but ESG overlay is going to be on all securities, everything that we're going to do, right? That requires tremendous amount of backend technology, processing capabilities. We work with a lot of partners. There are about 5-6 partners who give us data, solutions, technology on that, which will then make our capabilities even better. So the analyst bias just goes away, and data bias and analyst bias comes in when we start using this tool. So I completely agree. There's a whole lot of early days in what can be done. But on the wealth tech, obviously, there's tons that is going to happen in coming days. Even in the investment tech that we are looking at, there's going to be a whole lot that's going to happen.
Absolutely. I couldn't agree more. And if we can just zoom in a little bit, we've been talking in fairly macro terms around the trends, what's shaping behind it, the investor, the tech, and so on. Maybe if we look at the markets, I know Srini mentioned slightly earlier that the emerging markets seems to be, showing particularly promising signs in terms of that. I wonder if there are any, markets that people feel would be like, early adopters, shouldn't say early adopters, but, adopting this more rapidly and so on. Maybe Amir?
Sure, Helen. Well, there are two countries or two markets that definitely stand out in our view as fast adopters. There's Australia, and the major elements pushing ESG integration there are risk management and client demand, with fiduciary duty recognized as a key component, especially among fixed income investors. the advanced qualitative and quantitative study of ESG aspects that have been performed by Australian practitioners in order to offer insights at many levels, whether company, industry, and overall market. And corporate governance is by far the most integrated ESG component in the investment process in Australia. Environmental, social concerns are also expected to become more interlinked in the investment process in the near future there as well. We've seen China as well. So in recent years, China has experienced a tremendous increase in ESG investing. The inclusion of the China A-share market in the main indices has increased data coverage and motivated enterprises to create ESG databases. And the emergence of ESG investing in Chinese investment businesses began with the creation of these ESG products, for example, the green-themed mutual funds. And they've also begun to incorporate ESG terminology and consideration into research, procedures, and choices. But in Asia Pacific, these two markets stand out in my view.
That's really interesting. I know Australia has really been making, giant leaps in terms of, the whole governance thing and also around some of the offering. I wonder, are you seeing the same thing, Srini, from your vantage point?
Yeah, I mean, so we are a joint venture with Amundi, which is a global leader when it comes to ESG. In fact, they are the largest player in the ESG segment. So I see a lot of our mandate requests that comes for investing coming from European, Scandinavian countries, because they are very, very high when it comes to ESG expectation. They've completely integrated their expectation. Asian mandates or Asian expectations have gone up significantly in the last few years, right? In the last, I think, couple of years, the coverage of that from markets like Singapore, Japan, Australia, which Amit talked about, have significantly improved. But the quality of expectation that's there in Europe is completely at a different level altogether. The due diligence that they do in terms of when they look at ESG integration is at a significantly different level, because the markets have been investing in ESG for now over a decade plus, right? So in Asia, it's a very early stage. Having said that, one of the very interesting themes that we see in emerging markets like India, Indonesia, China, more so India and Indonesia, is this concept called just transition. So people are not really necessarily looking at making an ESG impact on a portfolio, but making it through bringing transition. For example, we have energy companies which produce energy on coal. And coal is a very important substitute for in markets like India. It's a big market, coal, and the coal actually gives huge employment to many people. Now, thanks to everything moving to greener energy, there is a huge gap in the way these people are treated. So there is now a lot of money that's going towards what is called as just transition, paying money to these carbon heavy companies to make them carbon neutral over a period of time and eventually low carbon, kind of stuff. So I think these are new trends which are very unique to Asia, very unique to markets like India, Indonesia, which is also becoming an important trend when a global investor looks at it. They'll say, what is your output that you're looking at just transition? Are you seriously, creating any other impact when you're looking at only ecological impact? You are probably creating a social impact, and how do you transition that social impact? So these are some of the new challenges that we face when we work in emerging markets. But purely from a demand point of view, I think 100% demand comes. I think there's virtually no investor interest if you say, no, it's not ESG when it looks at an European investor. Emerging market investors are still there, and a very interesting point that you brought in, 70+% of millennials are keen on it. So we see all of these young millennials being the first mover there, but eventually wealthy investors with which Amir talked about, which is basically family offices and others, are also coming up to this.
Absolutely, I couldn't agree more. I think the European countries, like Belgium, Netherlands, the Nordics, are really quite ahead in terms of that curve. They've been at it for much longer than Asia Pac has been.
I can just say that US talks a lot, but doesn't do much on it. The interest of investors, they're still very keen on, I mean, they've been talking a lot for a long period of time, but the US investors are not so keen like the Asian and the European investors. Sorry about that.
No worries, Srini. I think it's right. I mean, it's sort of moving from like a conference and talking agenda to actually putting your money where your mouth is, right? To actually, taking action. That's a totally different thing. A conference agenda, it does not mean it's a business or investment agenda, and so on. I mean, the reverse is probably easier. But I wonder from Ned's perspective, how do you see that?
I'm sorry, I'm not sure I entirely agree with Srini there. I mean, in the United States, ESG investments currently account for more than 20% of all professionally managed assets, totaling more than $11 trillion. So yes, maybe they're not moving as fast, but they're definitely there or have started. But bear in mind, the markets are much, much larger there.
Sure.
True. It's a tsunami, right? And so it's not just, it's sparing no one. I think it's just a matter of, at what degree. Hey, over to you, Ned.
Sure. I'll keep it brief because I know we're coming up on time. This is not my idea. It was something I heard from somebody. It was very profound when I heard it 20 years ago. I was at a conference, and 20 years ago, somebody asked about Asia being I've lived in Asia 30 years. Somebody in the audience, it was a Western gentleman, said, Asia in general is polluting the world. And this, he didn't say China or India, but he basically said Asia's polluting the world. And this guy on stage said something I never forgot. He said, may I just say, people care about what they breathe only after they know that they can have enough to eat. And it was a really profound statement because what he said was, sure, is Asia polluting? Yeah, but that's because people are still struggling to put food on the table, and you don't care about what you breathe until you care about that you can feed your family. And what I think you've asked about which areas, I think there's a very clear correlation. So Amir mentioned Australia. It's a rich nation. It's easier to care about the environment when you're rich. It's harder to care for the environment. But in the last 20 years, Asia has been amazing. From India to China to Indonesia to all these countries are getting richer. But here's the dilemma. As you get richer, you pollute more, right? We know that. You consume more. But then you care more. And so when you ask, I think care comes when you have higher economics and higher GDP. And we've seen Asia's been the biggest increase in GDP. Of course, we've got to balance out the polluting and the extra consumption. Like we all buy stuff we don't need. I do it, you do it, we all do it, right? And as you economically develop, you buy more stuff. So when you ask which countries care more in Asia, it's the ones that are getting richer. Of course, it comes with that unique balance, as that gentleman said, right? You care about what you breathe. You can eat all day, then you care, well, you can breathe, but then you're probably eating too much and you're making the air worse yourself. So it's not an easy question to solve.
Indeed, it's not an easy question to solve at all, but I think the three gentlemen here have brought in so much food for thought. We're still on a journey, I think. This is still very much a journey that we're all embarking on. So hopefully the sense of purpose and that, tsunami of things will really lead us to a brighter future. So, thank you again, everyone. We could go on like this for another hour at least, but unfortunately, we need to wrap up. Thank you everyone for being here. Thank you, Amir. Thank you, Srini. Thank you, Ned.
Thank you, everybody.
Thank you.